everyone. This is Jeff Praisman with Interactive Brokers Podcast. It's my pleasure to welcome back to the IBKR Podcast studio, NASDAQ's Michael Normile. Hey, Michael, how are you?
Doing well, thanks. Glad to be back.
Always love having you come in here for our monthly talk on the economy. And today, actually, for our listeners, just to kind of point out before we even get into the podcast, Michael and Phil McIntosh from NASDAQ wrote an article posted on their website, A Tale of Two Earnings Cycle. So we're going to kind of discuss that. Definitely would recommend checking out that article, but you by no means need to read it prior to listening to this podcast. The question's going to provide a lot of information. So I'm pretty excited to get started, Michael.
Yeah, sounds good. And there's some visual aids on the blog if you need them.
Excellent. So I want to kind of kick it off. How do earnings growth trajectories of large caps and small caps in the current economic environment, what factors into driving these differences?
I think on the surface, both large caps and small caps, they're posting strong earnings growth right now. As of Q4, the NASDAQ 100 saw 17% year-over-year earnings growth. S&P 600 small caps, they saw 9% earnings growth. So it sounds like a unified story where they're both doing pretty well, posting these near double-digit year-over-year earnings growth. But when you dig in, it's actually two very different narratives. So for the NASDAQ 100, it's been on a pretty incredible streak of 11 consecutive quarters and counting of 15% year-over-year earnings growth or higher. And that's driven largely by powerful operational tailwinds like AI infrastructure spending, cloud computing growth, and digital advertising strength. But for small caps, they've had their own streak that was 11 quarters, but theirs was for negative earnings growth. And that's before it finally turned positive in Q2 2025. And so
no, go ahead. Sorry,
okay.
didn't mean to interrupt.
Their recovery, it's been driven by different forces. So easing inflation, slower wage growth, and falling interest costs as we've seen the Fed pivot to rate cuts. So while those headline numbers look similar, the engines under the hood are quite different.
Yeah, and I'm glad you mentioned that with the small caps, because I wanted to ask you kind of how they've evolved over those past few quarters. And if you go a little bit deeper into what factors contributed to that recent turnaround, because that's a big difference, right? Like you said 9 negative in a row or
11.
11, yeah.
Yeah.
And then all of a sudden they kind of flipped the switch on that. So that's a big comeback, I would say.
Yeah, exactly. So it was in that earnings recession from Q3 2022 through Q1 2025. And they faced kind of a perfect storm of negative factors where it coincided with that period of really high inflation post-COVID where we saw 7, 8, 9% year-over-year inflation, and that squeezed their margins. And that was also paired with a historically tight labor market, which drove really strong wage growth. And so that had a bigger impact on these businesses and small caps. I should say they tend to be more labor intensive relative to large caps. And so that higher wage growth was especially challenging for those smaller businesses. And we also saw that, of course, the Fed had their really aggressive rate hike cycle from 2022 to 2024. And so that pushed up average small cap borrowing costs from about 4.7% all the way to 7%. So that's nearly a 50% increase in interest expense. And so, of course, these companies, they're really squeezed on all sides. But when that earnings recession finally ended in Q2 of 2025, and it's continued into Q4 of 2025, so that's 3 straight quarters of positive growth that we've seen. And that turnaround is really thanks to EBIT growth flipping positive as those inflation and wage pressures have eased. And the Fed's pivot to rate cuts has started to provide some relief on interest costs. So I talked about rates going up to 7%. Now they're about 6.6%. So a little bit of a relief there. And that's material because interest costs for small caps, it's 44% of their EBIT. So it's a really significant chunk of their earnings. And of course, right now it's a bit up in the air if we see further easing from the Fed with geopolitical things happening right now and potential inflation pressures related to that. But if we do see additional rate cuts, that should provide some additional relief going forward for these small caps. And to the extent that they have any shorter term fixed rate debt that needs to be refinanced, that could help too, where it's going to be refinancing probably at a lower rate than when they took it on. And so that's all these reasons coming together where small caps, they were hit so hard by Fed hikes, and it's really because of their reliance on floating rate debt.
Now, I want to take the other end of this discussion about the large caps, right? So what are the implications of the recent earning performances of these large caps? You mentioned some tailwinds with AI and cloud for the investors seeking growth-oriented strategies.
Yeah, and I think, of course, usual caveats apply that I'm not an investment advisor or anything
Right.
like that. So, but for growth oriented investors, the Nasdaq 100, its performance has been pretty compelling, especially as an index that kind of straddles large caps and mega caps, but also still growth stocks. And so
Mhm.
seeing 15% plus year over year earnings growth for 11 straight quarters and counting, that really speaks to the durability of the secular themes that are driving these companies. So again, AI, cloud, digital advertising. And it's notable that these large caps, they've actually been relatively insulated from those same macro headwinds that really impacted small caps. So those rising interest rates and the higher wage inflation. And that's because they typically operate with higher margins. So higher input costs have a proportionally smaller impact on EBIT. And they tend to be less labor intensive. So that faster wage growth also matters relatively less. And then, of course, they have more access to fixed rate financing. And so, because of that, in COVID, that was a historic opportunity to lock in low fixed rate debt for years, which a lot of these companies did. And so, I was talking earlier about the interest expense share of EBIT for small caps was 44%. Well, it's 9% for the NASDAQ 100. So, a lot lower interest expense relative to earnings. And so, looking ahead, we do see consensus estimates projecting this 15% plus earnings growth to continue, suggesting that there's still some runway ahead here.
And in what ways do the earning cycles of both large caps and small caps reflect the broader economic conditions and market sentiment?
Yeah, I think the divergence between large caps and small caps, it really tells you a lot about the uneven nature of this economic environment. So large caps, especially the NASDAQ 100, they've been riding that secular growth of those trends that I've mentioned before, like AI and cloud. And those are somewhat independent of the traditional business cycle where they've been more of a secular trend than a cyclical one. And so we've seen that with AI investment in particular, where it has been pretty interest rate insensitive. And so that obviously helps this group, which includes chip designers, cloud compute companies that are needed to train AI models. So this rate insensitive demand, you're going to still see companies spending on these products regardless of what's happening. And so that's really supported their earnings and reflects an economy where technology driven innovation is powering through those macro headwinds. But for small caps, they're much more of a direct barometer of the domestic macro environment. And
Mhm.
that's also because they're more domestically focused. So if you look at the revenues for the small caps, it's three quarters of their revenues come from the US. It's more like 50-50 for the NASDAQ 100. So these small caps earnings really gives you more of a picture of how the real economy in the US is feeling. They're more sensitive to wage inflation, input costs, and especially the cost of borrowing. And so now that we're seeing small cap earnings recovering, that's a signal that the broader economy is moving into a bit of a more favorable cyclical phase with easing inflation and some more accommodative monetary policy.
And I'm also not an investment advisor, so like as you mentioned, but with everything else, right? There's potential risks and opportunities, right? They kind of go hand in hand, risk and reward. So, what are some of the potential risks and opportunities for investors focusing either on large caps or small caps on the current earnings cycles that they've just gone through? Because we just kind of finished up earnings season.
Yeah, I think with large caps, of course, just to repeat some of the same themes I've discussed,
Mhm.
you've got strong operational momentum where the EBIT growth has been really, really strong and resilient for multiple years here, high margins, and of course, those durable growth drivers for things like AI, where they're these sort of secular trends. Of course, the risk is how much of this is already priced in. And the question is, how much more upside do you think there is there? And then, of course, when you get to talking about some of the largest companies in the world, there's been discussion about concentration risk, even though if you look at concentration in major indexes outside the US, they're actually much more concentrated than the US is. And then, of course, if you're saying, well, maybe these AI spending cycles are going to slow down or the market rotates away from growth, that could certainly create a headwind there. So, of course, realistic things that could happen, but we'll have to see. And then for small caps, the opportunity is you're getting in on this turnaround, I think, to an extent where you're coming out of a nearly 3-year long earnings recession. And now you have the cyclical factors kind of coming more in their favor with the Fed cutting rates. So their interest burden should continue to ease. And especially for companies that rely more heavily on floating rate debt. And then the risk, of course, being that maybe this recovery is a little fragile if we're seeing inflation reaccelerate, which of course looks likely with higher energy prices flowing through into the economy now. Small caps could find themselves back under pressure again. So, all this data that we're talking about, it's backward looking, right? We're talking about Q4 2025, and here we sit in the late stages of Q1 2026. So some very early Q1 earnings data is trickling in, but we're still a couple months away from getting a pretty comprehensive look at how companies were faring in Q1. So that remains to be seen.
And the monetary policy, I would assume that it would really impact, or it could impact the future earnings growth very differently for large caps and small caps. Is that a safe assumption? Is that fair that just given the makeup of these companies, it's going to have a different effect on kind of whichever path you're taking?
Yeah, and I think that's exactly correct. And I think there's really two ways to think about this. One is from the earnings side, and one is from the price to earnings valuations side. And so on the earnings side, monetary policy hits these two groups pretty differently because of their debt structures, like we've talked about, right? Small companies heavily reliant on floating rate debt, so they're pretty directly and immediately exposed to changes in the Fed funds rate. And so we saw that in the last cycle where their average interest rates went from 4.7% to 7%. Now they're down to 6.6%, and further cuts should help provide some relief there. For the NASDAQ 100, we're talking about their average interest rate in the last cycle basically going from 3.5% to 4.4%. So much tighter and lower range there, so less exposure for monetary policy in that sense. And then actually a lot of these large caps, they hold cash reserves. So some of them actually benefited from higher rates in that sense. So on the income statement, maybe future rate cuts are more of a small cap story, but rates still matter a lot to valuations. So especially for large cap growth stocks. And that's because growth companies, they derive a larger share of their value from earnings that are expected far out in the future. And when you're discounting those distant cash flows back to the present, that discount rate matters a lot. And so when interest rates rise, that discount rate goes up and the present value of those future earnings shrinks. And so that's why those growth stocks tend to see multiple compression during those tightening cycles, even if their actual earnings remain strong. And then conversely, when the Fed cuts, those discount rates will fall, and that will see the long duration future cash flows become more valuable. And then you get those multiples expanding on those growth stocks. So really, those rate cuts, they help small caps primarily through the income statement, lower borrowing costs, and then rate cuts help large caps, especially growth stocks, primarily through the valuation channel. So making their future earnings stream worth more today, which supports higher PE ratios.
Yeah, it's interesting actually to hear that large caps might actually benefit from higher rates just because of their cash reserves. I don't think that's something that most people are thinking about, right? They just automatically assume higher rates is going to negatively affect them.
Yeah.
You touched on this earlier in the podcast, especially with the large cap, with the sectors, right? The AI, everyone's talking about, obviously, cloud. What role would sector rotations play in the divergent earning performance of large caps and small caps?
Yeah, I think it's definitely a factor, right? The NASDAQ 100's dominance. If you look at it, the returns over the last few years, a lot of it does come from those AI related stocks in particular. And so these are sectors that they've been magnets for capital. They've seen strong EBIT growth, and that's overpowered any headwinds from things like interest rates or even taxes. And so over 60% of NASDAQ 100 revenues are from the tech sector, but for small caps, it's just 13%. And so data shows that for the S&P 500 large caps, for example, nearly all the margin expansion in recent years has come from tech. So this is a sector that's really been better able to expand margins and grow earnings, while small caps, they're more diversified across cyclical sectors like industrials, consumer discretionary, and financials. And they're more exposed to margin squeezing effects of inflation and rising wages like we've spoken about.
And what are the long-term outlook and sustainabilities of the current earning growth cycles for both large caps and small caps? I mean, small caps, obviously, you mentioned they had that very recent turnaround, right? The last 2 quarters where kind of large caps have been chugging along.
Yeah, and I'm going to rely on consensus estimates here since I'm not an equity analyst, but they're actually pretty optimistic for both. So the NASDAQ 100, again, is projected to maintain that 15% plus earnings growth streak, and small caps are expected to keep their positive earnings growth streak going, and for both of them, at least through Q1 of 2027. So another 5 quarters of keeping those positive streaks going. And so for large caps, sustainability probably hinges on whether AI and cloud spending continues to deliver real revenue growth and margin expansion. And I think one thing that people need to recognize is that all this spending going into AI, all that those CapEx numbers that you hear about, that is revenues for companies today because they're buying chips, they're buying hardware. So that does actually feed into current earnings for companies. It's not just investment that's years and years out. And so far, so good on that. And definitely we've seen a little bit of with investors becoming a bit more concerned about the sustainability of this demand in recent months. So it's become more of a question, even though it's proven quite durable through today. But we've definitely seen investors become a little bit more concerned about that. And then for small caps, the long-term outlook, I think it depends partly on the trajectory of monetary policy and the broader economy. So if we see the Fed continue to ease, inflation stays contained, the tailwinds that are supporting small caps now could continue. And then we also have this macro backdrop that's reasonably supportive, especially when you think of things like the tax cuts from the One Big Beautiful Bill Act, helping with costs and also supporting consumer demand. So I think there are some reasons to believe the consensus estimates that we've seen.
And I think final question, I think we can all agree that there is no shortage of geopolitical events going on in the world right now. And without going into any of them, I kind of want a more of a 10,000-foot view of both large caps and small caps. But in a general sense, how do like geopolitical events and like global economic factors, influence the earning cycles of large caps and small caps? Without knowing, I would venture to guess large caps are more exposed to the entirety of the world, more of usually more global companies versus small caps. But obviously, kind of throwing the question out to you, just to.
Yeah, no, I think you're spot on. I think this is really the flip side of the coin that I was speaking about earlier, where the NASDAQ 100 gets half of its revenue internationally. So it is more exposed to things like currency fluctuation, global trade policy, geopolitical disruption in key markets. But then you've got their higher margins and diversified revenue bases that gives them a bit of a buffer, theoretically, you would think. And then small caps, on the other hand, they tend to be more domestically focused. So they're less directly exposed to those geopolitical events, but they are more sensitive to domestic policy decisions. So again, the monetary policy, fiscal policy. And so that said, global factors like commodity price shocks or supply chain disruptions, they can still hit small caps through input costs and margin pressure. Of course, that's what we saw a few years ago during that inflationary period of 2022 to 2024, which of course coincided with that earnings recession for those small caps.
Michael, this has been great as always. Love our monthly meetings. And for our listeners, more from Michael, you can go to nasdaq.com and check out all of his great articles. Also go on our website, IBKR.com, go to education, and you can see past podcasts. And we cover all sorts of topics from the economy, different economic events. Michael, thanks again.
Yeah, thank you.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.